Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
And we are back. How's everybody doing out there today? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding Podcast. Mr. Geoff Gannon, how's it going over there?
It's going great, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else. Real quickly, just wanted to say thank you to everybody that's been listening and helping us out by giving us a rating and review on the podcast or on the iTunes podcast app. That helps us out a lot, and it's really helped put us on the map. I think we've talked about many times how the algorithm works with iTunes. So if you do want to help us out and you do like the work we're doing here and you want to support us, feel free to go to your iTunes podcast app and give us a rating and review. And we hope that's 5 stars. Helps us, get the word out. And, we spend a lot of time for these podcasts, so that would be great for us. So today we're going to be so people just keep sending in a lot of questions. Right. So they like these question and answer, I guess Q&As that we've been doing. And I think it's good also because we could just see what's really on people's minds, and we just get to answer them live on the show. So if you do want to have a question answered on the show, feel free to DM me. I usually compile them in a list, and then when we have a Q&A session, I'll just pull them up.
That's at Focus Compound.
Yep, that's at Focus Compound. And if you do want to reach out to me via email for anything, info@focuscompounding.com, and Jeff says Gannon on investing at gmail.com. So, alrighty, first question. What steps do you take to mitigate biases like confirmation bias / overconfidence in your research process and when making investment decisions? Good question.
Yeah, that is a good question. And it's a tough one. I guess confirmation bias is the one we could talk about the most, which is once I formed an opinion about some stock, presumably I buy a stock, I like it. So something like the safety of the stock, I think it's safe or something like that. Do I find things that reinforce that view? And ignore things that don't reinforce it.
Yep.
And that's probably one of the most difficult things. One of it is talking with other people. Often the people want to talk with you for 2 reasons. One, they really are interested in the stock sometimes. But 2, they're really perplexed by why you would pick some stock or something. So they'll talk to you a lot about the negative things that they see and the risks that they see. Yeah. And even if they want to buy the stock, they're usually talking to you about the risks that they see. The upside is pretty obvious that way. So I would say a lot of it does come from that, from people talking to me about some idea that they're aware that I'm interested in or that I write about. Often I don't necessarily own it first. And I do usually look at stocks for a pretty long time before buying them. So there's that kind of awareness of it. I certainly read lots of things from different people and try to read the negative things that they have to say about it.
I was going to say, wouldn't you say a big part also is like understanding why the shorts are shorted and kind of their thesis and their thought process? Absolutely,
yeah. And we have... some stocks I talked about before are, I suppose, more controversial that way, seen as risky. A lot of them aren't, and those could be harder. The ones where they're sort of, we focus on overlooked stocks that manage accounts, and some of them are literally just that, they're overlooked. Most people that I talk to don't have anything negative to say about the business or that it's risky. They just might think that it's not especially cheap or that it is very small, or they just haven't heard of it. It's not the most exciting thing.
So what would you think? What would you think about for KWL or NACA, where there's probably not a lot of people that write about it, right? There's not a lot of people that know about the stock, and there's probably not a lot of people that actually short the stock. I've never seen a short report on any of those companies.
That's true. Yeah. So NACA is a good one though, because there's a lot of people who are short something related to coal, and I did read a lot about. Just so people know, there's a company, Westmoreland Coal, which as we're recording this, I think may have, as we're recording it, just emerged from bankruptcy, or at least when you're hearing this, they will have emerged from bankruptcy. They briefly were in bankruptcy. And some of their business is similar to what NACA does. So that's a good one. I did read a lot about that company's bankruptcy and why it happened and things like that. So comparing it a lot to NACA and what could go wrong with them. It is, but still there is the risk of confirmation bias there, because they had a lot of obligations that NACA doesn't. And it's very easy. So doing that, you can be very easy to fool yourself then, because you're like, well, their situation at NACA isn't as bad as it was at Westmoreland a year or 2 or 3 ago.
Sure.
But that doesn't really prove that it's worth buying it. I think at one point, because it had this risk of bankruptcy, it probably traded at some incredibly low price, and people were excited by it. But I did read a lot of the. I found going back as many of the positive write-ups of Westmoreland as I could to see what people got wrong and stuff. That's actually, I find that to be better than reading the short thesis a lot of times, is to find something that has performed badly and read the good things that people wrote about it. So I actually did that with KWL from about 10 years ago. I could find a couple of things where people were very positive on it about 10 years ago, and the stock didn't perform well for 10 years. It was very flat.
Sure.
So it was interesting to read it and see, well, what did they see in it 10 years ago? Are they the same things I'm seeing in it today? That sort of thing. So sometimes that's better, is that when you know the outcome, using the internet now, because all those things are permanent, you can look back and see what the people got wrong in terms of the long cases.
What about like what they got right as well, where you can go back and like on VIC or wherever and see past reports that they wrote about the stock?
Yeah, you can see all those things, and that's very good that way. A lot of the most useful information I get, I would say, for reading reports and things, are not about stocks today, but sometimes they're even about a stock today. The information is useful, but they're writing about it from 5 years ago or something. A lot of times it's very helpful for learning about the management and things like that. We use the internet very heavily, so when we have an idea about something like a stock that I did a good amount of research on like timberland stuff and why people are positive on it or negative for a long period of time. For something like cool, it's true that there's not much. There was some from value investors. I probably read 5 or 6 pretty extensive write-ups on it in some form.
On KWL?
Yes.
Yeah.
Including one thing written up by now a member of the board. So actually there's a member of the board now. He got on the board as part of the dissident slate of investors. The hedge fund was about a 25% owner or something of it, and they won a vote. And one of the people they got on the board happened to have written a book about value investing. And there's an example he gives in the book which does not say that it is that it's cool, that it's KWL, that stock ticker, but you can tell from how he's describing it that it was.
Yeah.
So you can get this old case, and it's from before he was on the board and stuff. So it does give you some example. So it's presented like a hypothetical case, but if you actually read it, you can tell
that they're talking about a real life situation.
Yeah, absolutely. So there are even things like that you can find. Yeah.
Interesting. Okay, cool. And I think also just like being aware of it is a huge step as well. Like being aware of like the potential confirmation bias and how you could be subjected to it is huge as well.
And a lot of times being aware of your own past mistakes and your own sort of biases, you personally, even more so than what you read in like behavioral finance things or stuff like that. I think a lot of times people are aware of those things. They like to read about things about thinking fast and slow or whatever, those sorts of things. But the truth is, as the people who wrote those sorts of books will tell you, they know all those things, they've studied them, and it hasn't really helped them to not have those biases. Yeah, they still have those ways of thinking. And so often it's useful to think about your own biases. Like I'm very aware of the ways in which I do make tend to make the same mistakes over and over again, but also in some things that a lot of people might make the mistake, but I tend not to. So, for instance, I would I'd be much less likely to pay too much for a stock than most people would for a popular stock. But on the other hand, something I saw is a good business, safe, cheap enough, whatever. I might misjudge the durability of that business or something like that if there was a lot of like debt or something like that. So that's something I've been very aware of, is the downside risk from sort of leverage things, and that's because of past cases, whether it's Weight Watchers or Barnes and Noble.
I would say there's Weight Watchers come to mind.
Yeah,
because I know
those are two that come to mind.
Yeah,
those two stocks, Weight Watchers and Barnes and Noble, are good examples of the kinds of mistakes I made in the past. Yeah.
And if you're interested in cognitive biases, study Munger. That will help you out. And what's interesting? You're talking about thinking slow and fast. I'm pretty sure the author of that book, I think I read an interview once that he actually hated the book. Like he couldn't stand it. Like he did not like the book. He didn't think it was like good quality. He didn't think people would like it or benefit from it. And it's been such a popular book.
Yeah, that would make sense. Yeah,
it's kind of funny. Alrighty, next question. What do you think about the recent Fed actions? This guy really asked, but he was just he was kidding around.
Okay.
Because they didn't raise interest rates today. Okay, but then he goes on, tell us more about your sleuthing techniques.
Sleuthing, yeah. Mm-hmm.
Just Google Maps? Question mark.
No, there is more than Google Maps. So, well, I guess I just mentioned one. There was a hypothetical example in a book, which wasn't really hypothetical.
And a very long time ago, we put out a checklist. Like that was kind of like a roadmap for like how to find all, like sort of like the steps on that we go through with the investing process.
Mm-hmm. And a lot of people ask about those sorts of things. So, I guess I could go over some of them, the most basic things. So the most basic things are find the names of all the people involved. Whenever you find any sort of name of someone, there's always a proxy statement, which can be filed a couple different ways with the SEC, but is usually filed as some sort of, it'll be listed as 14 in some form. So it'll be like DEF 14, and then there'll be a letter at the end of that. And that'll give you information on proxy stuff. It can also appear in the 10K, but it'll give you information on who owns how much of the stock. And they'll have things like a name and address for those people, which will be like an office address or something. But by Googling those names and things like that, anyone connected to the company, you can start to see if there are family connections, if they're business connections, and look into the history. Like, okay, if you find out that this person owns a business which is in the same sort of business, so they own an aerospace related business or something, and they're a 5% owner of this stock, and this stock does something related to aerospace. Okay, well, is this a business relationship that they invested in years ago? Can you find out why? And usually you can. If you Google around and stuff enough, there'll be some sort of mention of it. So people's names are great. Specific locations of things are great. So I've said before, I do pay attention to where a company's headquartered, where it says its offices are, a lot of things like that.
Just to get like a general idea of like like where they operate in and stuff. Yeah.
And trying to figure out more about the history, because so often there'll be a local paper that will cover it more or something like that, you know.
That comes from just Googling around.
Yeah, and you can find things from many years ago about whether there was ever a attempt to merge with this company that failed, or this thing happened or whatever. I mean, I can think of one case where I had was able to find out information about a company's. We knew a company owned a building that it didn't need to use most of it, and it was in Manhattan. And I was able, by putting in that address and doing a lot of Googling, to find out that there was someone who had for a long time been interested in buying up an entire corner in the city and needed like 3 different buildings to do it or something. This building was a lot shorter than the others, but they needed to do it for whatever building plans they had in mind. Now, I didn't know if that would eventually go through or not, but it was a multi-$100-million idea that this person had to redevelop this whole thing. And you could just find that originally by starting by looking for the address and stuff like that.
Yeah.
So you always look at what the properties are and things like that as a value investor. It's probably easier with those things. We've said we go to county records for land and appraisal of them and things like that. We can always find tax appraisals of things.
And you were talking about the proxy, the people involved. I mean, that's kind of what Buffett did back in his early days. He wanted to see think how did the people think, and what sort of ticked them, or what got them going, or whatever. Was it money? Was it whatever?
Yeah. And a lot of times we'll have mention of each of the customers and things. So for instance, NACA has very few customers. So I have a list of all their customers and have looked up all the information on all of their customers. So I know who they sell to. That's easy because they have specific mines associated with specific customers. But there are some other companies that have relatively few customers, and we'll just say it. A lot of times with very small companies, for whatever reason, I don't know if it's they don't have the lawyers that are careful about, like, you don't really have to put this in here, but they'll just sometimes be just more open about it. They'll just list like 5 of their biggest customers or something. Where sometimes when you have a very big company, I've noticed I know who the customers they're describing. They'll say they'll say some big customer that uses our jets for their wide body aircraft or something. We know who they mean, but they won't even say what the company's name is. Things like that. For some small companies, they'll come right out and say it and list 5 or 10 companies. Oh, I've seen many 10Ks where they say we compete with companies such as, and list like 5 of them. Yeah. And it could be almost all their competitors, or it gives you a really good idea of looking those up. I
remember when we were doing research on Hostess brands, I think we were trying to figure out like which product of theirs like sold the most or something like that. And I can't remember. I don't think it actually broke it down, but when they were talking about what they like do sell, like their brands or whatever, you could tell it was kind of going from like biggest to smallest in that little table, but they weren't actually like coming out and saying it or like using percentages or anything like that.
But that's a great example. You can often find things that way with the order in which they say things. you realize is the same. Sometimes people do. I don't want to overstate how important this is because some people get almost paranoid about seeing things about what happens here, but you can compare by looking for the exact same lines in different filings each year, whether they've changed things. And I've mentioned that before. I know that I had mentioned before when people asked about it a while ago, I had said that I thought NACA would have better royalty stuff than in the past because they had for a long time said, we expect royalties to decline, and didn't give any reason why they thought it was. And when asked about it, they said, well, we just don't know what it'll be. So whenever it's high, we say we expect them to decline or whatever, as in our, but finally then they eventually this past year gave guidance where they said we expect it to substantially increase. That wasn't so much of a surprise to me because they had sort of changed the language that they've been using a quarter or two before then. And it's a sign when they finally took out something that they'd had in for a really long time that way.
Yeah.
And, I've talked about that before with things that you get used to certain very standard ways of companies talking about things like our industry is highly competitive is something that almost all 10Ks put into them.
Yeah, sure.
So when a company doesn't say that, it's a big clue. Like I was looking at one company recently and when they described what its products were and stuff, I wasn't really that into it. But I realized in something it said, I was like, it's saying something that makes me think this is very not competitive. And then I was able to find something else where they said, we're only aware of one other company that this technology has been licensed to.
Yeah.
So and from that, I was able to figure out that only 2 companies make this stuff. But the tip off to that was the way in which they very much were not using the regular language for saying how competitive their industry was.
Yeah,
what they're saying, what the risks were in the industry, what they weren't saying is competition, basically.
Yeah.
Yeah.
And that obviously stood out to you.
And then you go hunt down thinking, you write down maybe competition's really low in this industry, and then you sort of look it up. It's just like, I say that to people all the time, that it's like you have to write down like a guess based on, okay, well, this might be the situation here. Like there's something unusual here. You take it sort of as a lead. And when you see, this is, like normally when you see something about land or something and it's very easy to see, okay, well, this was land that they bought in the last 10 years in Iowa someplace. It's probably not that different from, what it is today. But if they say something like this land was acquired 100 years ago or something, in the information, then that becomes a thing that you become obsessed with figuring that out because that's such an unusual item in there.
Sure.
And that's how you do this sleuthing. Yeah.
That was interesting. Those are great answers. What changes have you made recently to your investing style?
Did
you start read 10Ks on the computer instead of printing it out?
No, I still read 10Ks through printouts. I don't know if I've made that many that recently. I could say over time there have been some changes, I guess. Actually, that's not true. So somewhat recently there have been some changes, and I guess I became more interested in some things that were cheap on a sort of asset basis. So like last year, for instance, in the managed accounts, we had over a third or something of the portfolio in things that were in some way related to land values of some kind. And I'd say that was very unusual for me. That's not something I'm usually interested in. I wouldn't say that's a change in my like investment philosophy or something, as much as just a reaction to prices for things, in that stock prices perhaps were rising a lot faster than land prices. Mm-hmm. You know what I mean? So it was becoming harder and harder to buy earnings at a cheap enough price, and so it became attractive to buy assets. Mm-hmm. And I've done that before where like I bought things in Japan or something. Part of that wasn't just that I was excited about something in Japan, but also that it was getting difficult to find things in the U.S. Mm-hmm.
Have you always thought about because when you're managing other people's money, it may be different than managing your own, maybe not, but like, have you always thought about stock working geometrically over time, where over time the business is going to do okay? I mean, did you always think about it in those terms? Yeah,
that's true. That's always been the same. Yeah. Where I was always thinking about it long term that way. Certainly the things that we own now are less leveraged than some things that I owned a few years ago.
I mean, purposely.
Purposely. Yeah. So yeah. And again, maybe that's an earnings thing though, a price thing, whereas we're able to buy some things. I'm able to find some things at the sort of same PE ratio that a lot of stocks have, but maybe the ones that have no debt or a little more cash, maybe I feel like the market might be undervaluing safety right now, I guess. Mm-hmm. So that's part of it. Is I don't know if it's like that my philosophy has changed necessarily in the last few years, but it's always changing in response to like what you're getting thrown,
like the
what
market,
opportunities by
is
the market.
changing, which just comes on your radar because it's cheap. Yeah.
Right. Because like I
so
think
like
in
land, and then I guess the fact that these levered companies could be unlevered companies are being realized by the market.
Like I have not owned tech things and stuff, but actually in the very early 2000s, I did own some tech things.
Yeah.
But that was because you had the bubble that burst in 2000 stuff, and so you had some become actual value investments, like in terms of assets and things in the early 2000s. So that can happen where it's a response to what the market is giving you that way. I think that things that are like very consistent, earning high quality businesses, I like them as much now as I did years ago.
Sure.
But the market prices that so much higher now, I feel, than it used to. So, like people talk about Buffett's approach to things and what he has owned and stuff. Part of the reason why he would buy Coke in now almost 30 years ago is just that kind of business was cheaper. Things like Coke and Gillette weren't valued as high as maybe they should have been, and now they're valued at least as high. I mean, He said that he overpaid for Kraft, and I think that's true. A lot of those food companies were overvalued. So, yeah. I mean, I have changed a little bit in terms of certain things of avoiding some kinds of risks, I would say. Mm-hmm. But other than that, I don't. I think that although I have changed in the last few years, it's mostly in response to what things are expensive in the market, which I would say is
just being
earnings
thrown
growth.
At you, really.
Yeah, like companies that pay a dividend and have good earnings growth each year, those have become so expensive. Yeah. So I probably bought less of them and more of other things lately.
Cool. How would you think about the value of Lyft, Airbnb, and other similar companies? And I'm guessing this is because Lyft just came out saying that they were like they lost like $900 million last year or something like that. So maybe that's just top of mind.
So that's a very hard question to answer.
Yeah.
And you might be able to answer better. I don't know. I have a somewhat different opinion on.
I think Airbnb is probably a better company than both Uber and Lyft. Why? It's because I mean, like you think about like Google and all these other people are kind of like in the self-driving car, I guess, race, if you could say, right? And Airbnb's like, it's kind of like they just set up the platforms, less capital intensive, so and more scalable, I would say, for sure.
Yeah.
But yeah, I mean, it'll be interesting to see what happens. I mean, because Lyft is going to go public, and Uber brought in that new CEO from, was it Expedia or something? No, I can't remember where. You remember where?
No,
I can't remember where. I want to say it was Expedia, but maybe I'm wrong on that. But and part of his goal was to actually bring the company public as well. So that's obviously going to happen. But yeah, I would say Airbnb is probably a safer, better company than both of those companies.
Yeah, I mean that would probably be true in terms of the industry.
Yeah, and I've actually listened to interviews where Brian Chesky, I think that's his last name, he's talked about Airbnb and how they're a profitable company, and I think it's good business.
Yeah, it's not an industry I know a lot about or something. I mean, I have like done some research and analysis of like booking holdings and things like that, which are related to those sorts of things. And in terms of like, for example, I guess maybe things like Lyft and Uber, those are somewhat unproven in terms of the industry. Yeah, it's an industry that I wonder how much of the returns will go to them. When you're talking about Airbnb, it's just in terms of the way that kind the product economics work. You would expect them to capture a huge amount of the value. One thing I wonder is if the system that Lyft and Uber have really means that they'll get a lot of the value and not that it will go. I mean, I think primarily, honestly, it goes to the consumer, and secondarily, I think it goes to the drivers. I don't. I mean, I've actually talked a bit with someone who drove and made who drove and made a fair income from it. And
how much?
How much?
Yeah. I don't even know what the average like Uber driver makes or Lyft driver. I'm sure they'll have to talk about it, but I have no idea.
Well, a big part of it was getting the car from Lyft. Was the ability to have the car. Yeah. And when they changed some rules on that and stuff, he stopped driving for them. But it is one that I don't know. I think I know enough about the industry that Airbnb is in that would be more comfortable saying that the winner in that industry will have a lot more go to that platform. I really don't know in the case of Uber and Lyft if so much of the returns will go to them or will go to other people. I mean, in some ways, that's probably more disruptive into society and stuff. So maybe it's good for society. Maybe it's a good that way. It changes the world and everything. But I don't know that it makes them incredibly rich.
Interesting.
Yeah.
Interesting. Well, that was 25 minutes. Let's see if we can get one more question.
Okay.
Here we go. What are some outstanding positive and negative examples of public firms that are focusing or neglecting to focus on creating long-term shareholder value by refraining from often value-destroying behavior, like risky acquisitions, short-term earnings targets, etc.?
Of really big companies, I guess we could say probably, I would say Amazon, Apple. I'd also say Costco. Each of those I can think of as doing things that, well, one, refraining from a lot of acquisitions that they could have done. Amazon has done some pretty big acquisitions. But I still
you don't ever hear about Costco doing anything like that, though.
No.
Yeah, just kind of stick to their business.
And when Costco opens new warehouses, it would take quite a long time for it to be earning as much. In terms of their as already open warehouses. So in terms of like return on equity and stuff, it depresses it as they make those investments. So I would say that those are just three that come off the top of my head. Certainly Apple's refrained from making acquisitions in a very big way compared to what other companies in there. I mean, certainly they've been encouraged to do that, I would say, at lots of different times.
Yeah, a lot of people want them to buy Tesla.
Yeah, there you go.
Yeah.
So... and Tesla is something I can't evaluate in terms of
I was
they've
say,
invested
what
a lot.
about
They certainly invested a lot. So.
What about those antics? Yeah, we need to have Peter Rabb over to come back on and talk about Tesla.
Yeah. So in terms of things that are value destroying things, I mean I do think there's too much focus on short term earnings. Earnings guidance and things like that. I don't even really like the idea of guiding for a year ahead for a lot of things. I mean, for some things it's okay. Like we talked about NACA.
Yeah.
NACA's not a competitive business. Their customers are giving them a lot of ideas about what the plant will produce and stuff. It's okay if they do that.
Yeah.
It never bothered me if BWX Technologies talks about what carriers and subs and stuff they expect to work on and produce for them. For an engineering company, it doesn't bother me in the same way. For the ones that are telling you we expect to win this much new business, that's where I worry about. We expect to sell this much new stuff to new customers. It's the sales part of it that bothers me.
Sure.
Not here's our backlog
Facts.
we expect to deliver. Yeah.
It was funny. Remember, was that last year that Warren and Jamie Dimon went on TV like trying to campaign against it? And I remember Jamie Dimon was like, "Yeah, if you're trying to beat next quarter's estimates, just like turn the jet off for a day or something like that."
Yeah.
Because then you begin on that game,
Yeah, and especially hitting an earnings line that way, where the company says, "Oh, we just missed a little on revenue, but we made on earnings or whatever." Yeah, that is what he's talking about. That is the kind of thing you could do. Yeah. So
just kind of financial engineer it a little bit.
Yeah, and there are some particular ones where they want to hit like a certain percentage of it in terms of like, often it's digital or something is the big thing now, but it's something like that. That kind of stuff does worry me. Yeah. When it's almost like we want to move people to something that sounds more high tech or of a more new thing. You always get that. I mean, sometimes it's good, but like I did a write-up of Residio Technologies. And I think it's good over time if they move to doing more stuff on a subscription basis and more, connected things, and they can do that. But I don't really like when I feel like sometimes a company like that is trying to present to investors, oh, we're not an old technology company. We're not this old thing that's just your thermostats and your things that none of this is connected and stuff. We're like an internet of things or whatever, and so when they say like we want to hit a certain number next quarter, next year, a certain percentage of our stuff will be this connected stuff or whatever. Do the customers really want the connected stuff right now? I don't know. Do the contractors want to put that into places? I don't know. Yeah, that's pretty interesting. Why do you think they do that? Because they want the market to think differently about them? Yeah. Is it kind of like the Enron thing, how they never wanted to be known as a trading company because the multiples are different? Yeah. No, I do. I think that some of them do presentations to investors and things and realize that investors are like, that's old school of whatever things that you're doing. And, and sometimes it makes sense and sometimes it doesn't. Because there's, think about like Disney or whatever. Years and years ago, I'm sure people were saying to them, oh, you have to get into all this new media things or whatever. Yeah. Then they come out, they have Marvel, and then they put out Marvel movies and stuff, and they're like, oh, no, that's okay. Now, now that those make $1 billion, you can do this stuff that is basically the same stuff you were doing, the same sort of blockbuster movies you were doing 20 years ago or whatever. Yeah. It works out fine. So sometimes, a lot of times it's best not to just listen to the analysts that way, to listen to the market, because the market's often focused on like comparing you to what's the new hot area in these few years,
Interesting. Cool. Well, I think that's a good place to stop this week. I want to thank everybody for sending in questions. Of course, again, like I did say, if you want to have a question answered of us, please just go ahead and email either Geoff at GannonInvesting@gmail.com. You can email me at info@focusedcompounding.com, or just send me a DM or tweet at me at FocusedCompound on Twitter. We compile all of them together, and then we'll definitely chat about them on the show. If you do want to get access to Geoff's weekly memo that he sends out for free, there's a premium one for members, and then there is a free one as well. Go to FocusedCompounding.com, enter in your email, and then you'll receive that in your inbox every single week.
Yep.
Anything else to add?
You could rate and review the show on the podcast
If
app.
you want to make Geoff happy, rate and review the show.
Okay.
Give a comment. We're just trying to make Geoff happy.
All right.
Thanks so much, everybody, for tuning in. We'll see you in the next one.
Hey, this is Geoff Gannon, and that was the Focused Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focusedcompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focusedcompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.